the event. So get things started here. Good morning, everybody. Welcome. I'm James Chrisbrook, the 2020 GMAR president. I'm so honored to be serving this year. Wasn't the year we planned on, but the challenges are certainly moving us along exponentially. And I think a lot of the technology, like we talked about with Zoom, was probably coming 3, 4, 5 years down the road, and it's just moved that up exponentially. And we're finding all new ways to communicate. Not the way we wanted to, but that's what we're dealing with now. So, I thank you for taking time out of your busy schedules to be here and have your morning coffee with us. Hopefully everybody has their coffee. I've got my, oh, you can't see it. There we go. My Realtor R mug. And a little bit of housekeeping. We're really excited to learn from Dr. Yoon today. Please make sure you mute yourselves as you arrive to the Zoom. We are recording this session, as I said, so we want to be sure background noises are kept to a minimum. Also, you can go ahead and open up the chat box. If you look down to, I have share your screen, but if you look down to the bottom, it says chat. You click on that and it will open a chat box to the right. So you can see other people making comments to each other, saying hi. As I said earlier, this is like a family reunion. It's so great to see so many of you. I wish we were in person. So you can this will enable you to be able to ask some questions in the chat box. And then when we're done, if we have time for some questions, we'll go through that in the order that they were received and try and get your questions in. I'm sure you guys will have lots of them, and we'll give you some links where you can go get more information. So we will keep everyone muted from our end right now to avoid any confusion. As I said, since we have over 300 people joining us. And again, we'll also live stream this on YouTube and on Facebook so folks can see what's going on. So who are we as GMAR? Hopefully all of you know how to check us out at our website, which is gmaronline.com, and we will post that in the chat box. I'm hoping all of you have been there before. GMAR is the largest association in the state. We have about 9,500 members as of today, and we've been growing, actually, not at the rate that we have in the past, but in spite of the things that we've been dealing with. We see lots of new realtors wanting to get into the business, and a lot of realtors deciding that GMAR is a better place to be. I say that proudly, as we offer so much education. We didn't miss a beat. When it came time for the shutdown, we were prepared. Our physical office is still closed, but all of our staff are working from home, and it's pretty great to have that going on. We just started curbside pickup if you want to do some shopping in our tool shop, among many other things. You can go to gmaronline.com to find out about that. We also have a great resource page. So we've really worked very hard to support our members through all of this. We've created some special programs to help them make their GMAR dues payments. We've waived the fee to join us, as well as many other things. One of the big things we did is that because we've saved so much money this year on a lot of things, we took $40,000 and donated it to the Greater Realtors Foundation and created a benevolent fund. So we've been able to help a lot of realtors just with everyday bills, electric bills, paying their real comp dues, whatever it might be. There's a simple application process that you also can find at GMAR Online. So we're really proud to do that, as well as we did GMAR Cares, which was a drop-off of physical items, and they were donated recently to a women and children's shelter, and it just made their day. And we had August on our team had her office full, so it was great to see that kind of response from our members at GMAR. We have classes online still, so if you'd like to take a class, take a look at our calendar at the GMAR Online website. We're doing all of our classes virtually right now, but we're getting a great response, which is awesome, and a lot more engagement from our realtor members. Something very special we're doing this year for all of our members. It's through a Zoom class, and it's online, your continuing education. So we're offering Con Ed to all of our members for free. There's no payment that you need to make like you might have in the past. And so we welcome you to jump on. This is the place to get your Con Ed. It's not, and I say this unashamedly, it's not an underwater basket weaving course in order to get your Con Ed requirements. It's actual education that will help you in your business, help you grow your business, because we want you to stay strong and healthy, both physically, emotionally, mentally, and certainly in your business. So I'm going to move on now, and I know we have Dr. Yoon on the call, and I don't want to take up any time from what he's going to say today. So I'm happy to introduce Dr. Lawrence Yoon as our special speaker today. For those of you that may not know, Dr. Yoon is the Chief Economist and Senior Vice President of Research at the National Association of Realtors. He regularly provides commentary on real estate market trends for our over now 1.4 million realtors. By the way, we are the largest trade association in the United States, so there's a lot of us, and we continue to grow. Dr. Yoon has appeared as a guest on C-SPAN's Washington Journal and as a regular columnist on the Forbes website. We are delighted to host him today as he shares his economic predictions with us. So, ladies and gentlemen, Dr. Lawrence Yoon.
Thank you, President James, for the introduction and for inviting me. The last time I was with President James Chrisbrook, he was in Detroit area. It was winter, I remember, because it was cold, and Detroit, it can be quite cold, but in completely different circumstance. The unemployment rate at that time was at all-time or 50-year low for across all demographic groups. And we certainly did not have this economic lockdown. So tremendous changes, conditions. And given this, I would like to provide as to how I see the market developing. So please bear with me as I try to upload the PowerPoint. As an economist, we speak much better with the slides. So let me put that up and put it in the slideshow and go to the first slide. Okay, there we are. All right, so the broad view of the economy is that we have had 10 straight years of economic expansion, the longest economic expansion ever. And then we are hit with this unexpected lockdown from the virus emanating from China. So the first quarter, the broad measurement of the economy is down 5%, and that was due to the consumer and business spending collapse, as you see on the chart. Most interesting part of the first quarter data is the residential investment, which comprise home building activity, home sales, remodeling spending, and it grew at 18%. Showing that just how strong the housing market had been before the pandemic. The lockdown went into effect. I pretty much remember it was in mid-March because I was looking forward to the March Madness basketball tournament, but it did not happen. So even with the second half of March shutdown, residential investment very, very solid given what has happened in January and February, quite strong. The next two sets of data is not the first quarter, but the latest available data related to income. Income in April, in the midst of the pandemic, as people are staying in shelter, grew by 12%. And you have to shake your head because there's a loss of wages from job cuts, entrepreneurial income, realtor income has fallen as businesses were completely disrupted. So how in the world is it possible that personal income for the country as a whole rise by 12%? And the answer is the massive, massive stimulus package. The stimulus check, $1,200 plus additional if you have children at the home. And then the small business help. Many are initially considered a loan, but you don't have to pay back if you meet certain criteria. And as NAR, we've been advocating to say, please provide us with more flexibility about small business loans. Because it's not only about paying wages, but paying rents, paying for all this fixed costs, the copiers, and another part. And then personal income grew. But as we know, restaurants were closed. The baseball season did not start. So what did people do? There's no place to spend. They saved up that extra income that came from the stimulus package. 33% savings rate, highest ever in the US, which means that as the economy steadily goes into phase one, phase two reopening stage, there could be an unleashing of spending power into the economy. Now, if we look at the job market, everyone knows it's quite ugly. 20 million job losses in a single month of April. Most of those jobs losses related to leisure and hospitality. Anyone working at a hotel sector, airlines, they can tell you no business. Disney World was closed, but they are now scheduled to reopen in mid-July, so let's see how that goes. But the other job losses appear to be temporary in nature. For example, second line, 2.5 million job losses in education and healthcare. When you see the imagery of the heroic efforts by nurses, trying to tackle the COVID-19, we want to just go out on the street and applaud them to say what a great work. But believe it or not, there were job cuts in nursing and in medical profession. It occurred. I think I'm hearing a little noise, so just in case you forgot to mute, please mute.
Could you please, everybody mute your microphones? Hello, we can hear somebody. Please mute yourselves. Thank you. Sorry, Dr. Yoon.
So continuing, that even during the COVID-19 crisis, we had people in nursing lose their job. And you say, how is that possible? Well, every non-COVID related healthcare related activity, like say hip surgery replacement, those cannot occur. So those had to be postponed until economy reopened. So now that the economy is reopening, all those postponed surgery can now take place. So nurses need to be rehired, doctors rehired, dental offices need to be fully back online, hair salon. So many jobs will be soon coming around, including construction. We are short on mid-price homes, and we need to build more homes in the mid-price range. Upper end, plentiful inventory, but mid-price and below, shortage of inventory, so we need to build. So many of these jobs will come around as the economy reopens. We have to just simply cross our fingers that we don't catch the second wave of the virus. We know that in some states now they are reaching a record high in terms of the coronavirus new cases, because we just need to avoid that second lockdown, which will be completely demoralizing for the economy and permanent negative damage to the economy. So please follow the social distancing guideline. They said that's quite safe activity. You go to grocery store, social distancing, fine. You visit other people's home to show the home, and it is much safer than going to the grocery store, but follow the social distancing guidelines. So let's look at the US job market before turning into Michigan. So US job market you see is that from year 2000 to middle of the chart, there was some job growth. But in hindsight, we knew that job growth was artificial because it was led by funny subprime mortgages that overstretched people's budget. And consequently, it led to foreclosure crisis and job losses. We need to assure we don't have subprime lending. Unfortunately, over the past 10 years, we did not. Mortgages were soundly underwritten, and we had 10 straight years of job creation in the US. Before April, in a single month, all that jobs wiped out. But as I alluded, many of those jobs are temporary job losses in nature, and some jobs will steadily come around with the reopening in the economy. The leisure and hospitality, I think it may take a long time or until the vaccine is discovered for that to happen. When we look at Michigan, or I should say Detroit, greater Detroit metro area specifically, it looks like the following. Everyone knows the auto industry troubles. So even as the rest of the economy was creating jobs from the year 2000, Detroit was losing jobs because very tough situation in the auto industry. And then when the foreclosure crisis hit, further leg down in terms of job losses. So if you see from the very beginning of the chart to the middle, that is a 500,000 job losses in the greater Detroit area, quite a pain that you have experienced. But from the low point of 2010 to today, or right before the pandemic, it is around almost 300,000 job creation. And it was this job creation that was steadily building up, leading to housing demand, housing demand, housing demand. Then in a single month, look at the job losses, boom, all gone. And with Michigan being in a stricter lockdown compared to other states, you went down a little more in April, relatively speaking, compared to other states. But that's the trade-off. You want to contain the virus, but that requires stricter lockdown. But if you're a little more relaxed, say like in Florida, Texas, the economy is holding on a little better, but they are getting the potential second outbreak on the virus. So the trade-off between lives versus the livelihood that is playing out in the country. Now, if we look at the unemployment insurance situation, before the pandemic, it was a small blip, essentially nothing. And then from mid-March, you see the surge of people who are coming up to the unemployment offices to say that they need to claim for unemployment insurance. These are first-time filers, people who have been laid off and filing for the unemployment insurance for the very first time. And it's steadily diminishing, at least that's a good sign, sort of flattening the curve. But if you look at the total number of receiving, because I think the media actually is somewhat misleading in this regard. So if you add up the total number of people who are laid off and filing for unemployment insurance, you see that it is 45 million people. But how many are still receiving unemployment check? The total. Today it is 20 million, not 45 million. So initially from mid-March, you see the total number still on unemployment roll is rising because we have new cases. And then it's begin to stabilize. So what this is telling is that even as people are getting laid off, filing for unemployment insurance, some people after 2, 3, 4 weeks of unemployment, they're finding job. Maybe they're finding job with FedEx. Maybe they're finding job at Amazon warehousing or finding job at the local grocery store. So even in the midst of the layoff, people are finding job. So the number is not 45 million, which the media just keep pounding, but the number is actually 20 million because there's some job creation that's occurring in the economy. And if we look at Michigan, Michigan looks like the following. The number of the new filers just surged in late March, April, but the number of fresh layoffs you can see is tapering off in a fast way. But if we look at the total number of people still receiving unemployment check, it looks like this. Something like in the week peak, now it's beginning to be a little lower. So in Michigan, there are job creation also occurring even with the fresh layoffs. One other thing that NAR, getting all the information from the local association presidents and other people are very active. So thank you, President James Chrisbrook, in your effort, is that NAR for the very first time advocated, made a case to Congress to say the independent contractors, realtors should be eligible for unemployment insurance for the very first time ever. And they agreed with us because it was a government imposed lockdown. So please, during this business disruption, tap into the unemployment insurance. I know the realtors, you are high energy, you want the commission check, you want to get the business deal done, but it was disrupted due to the lockdown. So please tap into the stimulus measure like unemployment insurance, pandemic relief temporarily, because we're working with the local association presidents across the country. NAR, we lobbied hard, and please tap into the available resource. The unemployment picture, again, is not back to normal by any means. But here's the interesting data. You look at Michigan, every first grader know where Michigan is, the mitten, they just look for the mitten, and you see that $2 part. So what does that $2 represent? Well, let me look at Wisconsin, which is that $261 in parentheses. So if you are working in Wisconsin and you got laid off, on average, your unemployment check was short by $261 per week. So if you are laid off on average in Wisconsin, you are worse off. But in Michigan, you are actually better off by $2. I mean, that's not that significant, but what it means is that if you got laid off at Macy's and now receiving unemployment check, that unemployment check is probably replacing all the lost wages. So this is an enhanced unemployment insurance. In Ohio, they're actually getting $110 more on average. I mean, some people are better off, other people worse off, but at least there is a effort to replace the lost income on average. So unemployment picture looks bad, but at least there does not appear to be panic. And if you look at the rent payment in the apartment sector and others, the rent payment is running almost same as 1 year ago, even with high unemployment, because people have the income to make those rent payments. So things are bad on the job wise, but the income situation is at least they're getting some support. Now, for the monetary policy, the Federal Reserve is aggressive. They are very accommodating, and they are doing everything possible to provide liquidity to the market, including something called quantitative easing to buy corporate debts, mortgage debts, government debts, many, many things. I guess this chart is less important than the following chart for the real estate professionals. Record low mortgage rates. The blue line represents the mortgage rate, and we are at an all-time low. It generally follows the orange line, and the orange line is the 10-year Treasury borrowing rate. But if you look at the last data point, you see that the gap is a little wider than normal. So if you wait 1, 2, 3 weeks, it's possible that the mortgage rate may actually inch down even further to maybe 2.9%. Possibility, not a guarantee, but certainly a possibility. But the one mortgage that is not working is on the jumbo loans. Mortgage originators, your clients, they're getting mortgage from Wells Fargo, from Quicken Loans, and other mortgage brokers. But the reason why those mortgages are available is the lenders know they can sell it to Fannie and Freddie. By definition, jumbo mortgages, Fannie and Freddie cannot purchase. And hence, jumbo mortgages are not working in the current environment. So if you have to sell those $1 million home, it may be a little difficult. First, there's plentiful supply, but second, the demand is a little difficult in terms of trying to obtain those loans for expensive homes. So keep that in mind. Now, the inventory situation is very low. One question that I've received from the reporters consistently in the early weeks of the pandemic is to say, should we anticipate foreclosure crisis? Prices plunging 30%. Certainly the greater Detroit areas felt that pain 10 years ago. And I said, look at this chart. This chart is showing a completely different picture. 10 years ago, we had oversupply. We had those funny mortgages explode, blow up. So we had an oversupply situation. Today, we have an undersupply. And given the undersupply situation, vast middle market home prices will remain solid. Only the upper end, you may require reduction, but on the properly priced home, you look at the comps, you see what the appraisal will come in, you price the home correctly, don't be surprised if you get multiple offers because the demand is very strong because of the record low mortgage rates. Now, the first evidence of the market suffering from the lockdown is the pending contracts. So it fell in March and April, and consequently the closing activity, which would follow the pending contract with about a month lag time. No surprise, in the month of May, it hit a low point. But I believe this is the absolute low in this cycle. Why? There are many good indicators. First, pending contracts have been rising in May, which means that June closing should be a little better. And furthermore, look at this, very early phase of home buying process. This is mortgage application to buy a home. As a realtor, you always tell your clients, get the mortgage approval. So your clients are applying for mortgages. And how is that application doing? Well, before the pandemic, it was running about 10% above 1 year ago. In the midst of the pandemic, it was down 35%. But what about now? It is 20% higher compared to June of last year. So if you thought the summer of last year was pretty decent, this is indicating that this year could be even better summer if all of the mortgage application gets approved. Now, not everyone will get approved, but there is a strong interest to buy a home based on mortgage purchase application. I believe the worst in the housing market condition is clearly over absent the second lockdown or the second wave. So let's contain the virus. Let's ensure that we follow social distancing protocol. Here's an interesting data. This data is fairly new. It's based on the technology companies looking at the GPS of these cell phones. Are people simply staying home, or are they moving from one location to other parts of the town? And I put 3 states. Georgia was very controversial because they were reopening early. Some people thought too early, and that will lead to the outbreak of the virus. So Georgia is the blue line. So you see that after the lockdown, they're reopening first and coming around. Green is Michigan. So you had a strict lockdown, so you went down a lot, just like New York State. New York State had a strict lockdown. But Michigan began to reopen, and look where Michigan activity is in terms of people moving from one place to another. It's already matching up with Georgia activity, but New York State, they are sort of a little later, and they still only, I think last week, they permitted realtors to show homes, only last week. So New York is a little late in terms of reopening the economy. They want to contain the virus. So you see a little variation in this chart. Now, housing shortage for those mid-price and below will not go away because home builders cut back on production during the pandemic. So if you had a housing shortage, inventory shortage in 2019, before the pandemic in 2020, then you will continue to have the housing shortage because builders have pulled back during the pandemic. So this shortage will not go away, only on the upper end market, planning for inventory. This is a very ugly chart. Federal budget deficit, but it's a require because we wanted to provide income support for people, unemployment check, small business stimulus check, but it's not a free lunch. Huge debt. Who is buying this debt? Is it the Chinese government? Is it the Michigan Teachers Union Retirement Fund? Is it ordinary grandmothers? Who is buying this debt? Currently, the major purchaser of this debt is the Federal Reserve. I'm near Washington. I'm in Arlington, Virginia, office in DC. I have not been to office since the pandemic breakdown because NAR policy work from home. Excuse me. So in Washington, everyone knows about the White House and Congress. Supreme Court is independent, same as Federal Reserve. Federal Reserve is independent. So Federal Reserve can pursue their policy independent of Congress and the president. And what the Federal Reserve has been doing is purchasing a large quantity of this debt. Where is the Federal Reserve getting the money? They're printing money. So in other words, you can simply say the unemployment check people are receiving, that's printed money. But it's required to provide a stimulus. But if we print a lot of money, isn't that going to cause something bad event in the future? And I will say the following. America has a special privilege with the US dollar that no other country has because of the many, many years of credibility. You take a $20 bill and you go to Mexico, or you go to Canada, or you go to South Korea or Italy, and you show that $20 and say, give me a haircut, and they will happily give you a haircut for that $20 bill. In other words, people will accept the US currency so we can print money and not have inflation right away. But we need to print more money next year. So if we keep printing money, isn't that going to cause inflation in the future? And I would say maybe we get a little higher than normal inflation in future years, 5 years from now, 6, 7 years from now. So at that time, prices of everything will be rising, including real estate prices. Rents will be rising, food prices. Social Security check will be rising, even though your standard of living is not rising because everything is more expensive. But there's a one item which will not be rising, and that is mortgage payment of those who are locking in today at a historically low interest rates. I would say we will have this low interest rate for the next 18 months. Take advantage. Maybe you want to communicate with your clients that fixed monthly payment is fixed. It doesn't change. Explain the factual. Federal Reserve is printing a lot of money. Will there be higher future inflation 5 years from now? I don't know. But printing of the money somehow shows up as inflation in the future years, maybe not like the 1970s style, but maybe a little higher than normal. Something that you may want to communicate with your client. Let me go to now the forecast and wrap it up. So the forecast is that 2018, 2019, the actual figure does not mean so much to you. But if you look at the percentage change, in the first quarter, home sales were running about 5% higher compared to 1 year before. Second quarter lockdown, I think it's going to be down about 28%. Then third and fourth quarter, less severe decline. In fact, mortgage application is actually implying that it could actually be positive in the second half of the year. Let's hope that's the case, but my economic model is suggesting this. And we go into 2021, everything lights up positively. GDP, job gains, home prices, and home sales, I think it's going to be very robust, 13 to 18% growth. And that whatever missed home sales in spring of this year, I think will all be made up in 2021. So let me just stop there and turn it back to President James Crisbrook.
Great, thank you, Dr. Yoon. And we know you don't have a crystal ball there, so these numbers obviously are dependent upon no second wave, I would assume. So we do have some questions in our chat, and we're going to try and get through a few of them here. So I'll just quickly say, so Tom Goebel asked 9,500 members at GMAR. So in Michigan, there's about 45,000 real estate agents, and there's about 33,000 realtors, just to give you a quick on that. And from Yuzin, I hope I'm pronouncing that correctly. Why does Detroit area job count exhibit a roughly annual periodic behavior? I don't know if you have the answer to that, Dr. Yoon.
So I think what I showed was that for the state of Michigan, those are what's known as non-seasonally adjusted employment. So what it shows is that during the winter months, there's fewer jobs. During the spring, summer season, there's more jobs. Maybe it's lifeguard, it could be some summer occupation. I don't know specifically about the auto industry, but I understand in auto industry, somehow every year, once 1 month of the year, they sort of close the factory to retool many things. So maybe there's part of that explanation. But there appears to be sort of normal seasonality every year where there's more job in the summer, spring months compared to other months.
So from Paul Curtis mentions that obviously numbers have been spiking, 45,000 new diagnoses yesterday. So clearly there's some states, as you mentioned, in a upward movement with regard to the virus. So if there's another severe lockdown soon, what will happen to housing?
So one of the things that's holding up the home prices is that income support, but another part is the mortgage forbearance. For people facing economic hardship, you don't have to make the mortgage payments for 6 months, and then additional 6 months if you can prove you are continuing to face economic hardship. So if we have a second wave, whether or not Congress will pass new legislation to extend that 12-month period to 18 months, because right now the goal is to say, let's give people time so that job market can recover and they can catch up. And by the way, missed mortgage payment is not a free lunch. Whatever missed mortgage payment is just being tacked on at the end of the life of the loan. It's not a balloon payment, or if you need to sell your home, that you will have less equity from the missed mortgage payments. But at least that has led to the no stress in terms of people needing to foreclose or things like this, even in a tough job market condition. So if we have a second outbreak, certainly everything turns worse. And like the mortgage forbearance situation needs to be extended. More fiscal stimulus means more printing of the money. So we just have to hope that we don't have the second outbreak. I mean, I'm not a medical expert on it, but as I read, what I'm hearing is just very simple: mask on, social distancing, outdoor is quite safe. It's a little wind. But it's the indoor activity without social distancing, talking to person very closely for 15 minutes, that's when people catch virus. So as you look at other country, I mean, I'm originally from South Korea. I look at South Korea, So when they talk about second outbreak in South Korea, they're looking at like 60 people, and they can clearly find immediately who those 60 people are and where they have been contact tracing. They inform other people stay home, but the rest of the people are busy. They're going to the restaurant. They're doing the. So I think that people just following the normal social distancing guideline will greatly contain. So let's hope that's the case.
Gotcha. Yes, agreed. So the prolonged period of low mortgage interest rates, has that been a factor in the persistent low inventory levels of the housing market? And I believe there's low inventory levels across the country that we've been looking at. So do you believe that has a great factor in it?
Well, the low mortgage rate has induced buyers to come in. So right now, high unemployment rate, but I would say 70% of Americans would say they have a secure employment and they are looking at the lower interest rates and they want to take advantage of that. So the low interest rate is raising the demand, but the supply is home building activity. We need to build more homes, which we have not been doing, and that is the cumulative impact of underproduction by the home builders. So as the economy reopens, we need to start the home building activity, especially the mid-price and below. That would be critical. And also it helps the local economy, more construction jobs, secondary spending impact. Work with local association, talk to the mayor, county commissioner to see what can be done to bring more homes to the market.
We have a couple people that have asked questions about the jumbo loans, when that market might open up, and just if you can give us a little bit more information on that.
Okay, and this question and one more, because I have to
gotcha.
have a hard. So on the jumbo market, so initially, many lenders were afraid. If they can sell it to Fannie and Freddie, it's fine. But lenders were afraid that home prices could decline, their collateral value will decline, and they will be unable to recover the money. But what they are sensing now is that home prices are not declining on a massive scale. Overall, nationwide, home prices are actually higher by 2-3% from 1 year ago. So given that, maybe some of the lenders who had assumed high risk situation now say, well, maybe we're not in a high risk, so they can provide those jumbo mortgages. So with more information, I think it should be less severe on the jumbo mortgages. And also another thing that's impacting jumbo market is the mortgage forbearance. Believe it or not, mortgage forbearance is buying time for some people, but it also means that the lenders are not getting those mortgage payment, but they still have to pay property tax, they have to pay the insurance, escrow, they have to pay the mortgage payment to their investors. So they're facing a little cash crunch, and hence they are saying, well, any mortgages that we have to hold, like jumbo, we got to be a little more cautious.
Great, thank you. We're going to let you go. I know you had a hard stop on this, and we certainly respect your time. You're a popular guy, and we're honored that you could spend some time with us today. So Dr. Yoon, thank you so much. We look forward to hearing more from you. We just heard that the national conference is going to be virtual instead of physical in New Orleans. So hopefully we'll hear I'm sure we'll hear some things from you in November around that time. But we certainly thank you for guiding us through all of this and for your voice across the country representing Realtors. So thank you, Dr. Yoon, much appreciated.
Thank you, everyone. Have a wonderful day.
Thank you. Okay, so folks, let's wrap this up. I know we weren't able to get to everybody's questions or comments, and I apologize for that. Of course, getting Dr. Yoon scheduled for something like this is pretty extraordinary. He's got a very busy schedule, especially these days. So we will get to everybody's questions. The information, we are getting the slides from Dr. Yoon's team. So we will be able to share those with you. And again, this session was recorded so that it can be viewed at a later time and be available to you. So I want to just wrap up with a few things. Certainly you can still go to gmaronline.com to get information, nar.realtor.org, which will give you lots of information with regard to all of this. And it certainly will help you guide your business as we go forward. Please remember, as Dr. Yoon alluded to, face masks, social distancing, being very careful when you are showing houses, respecting the governor's executive orders with regard to these things. We were one of the last states it was us in Pennsylvania, to be able to open up and practice real estate. And we made some promises to the governor and to too bad, to the state, that we would do certain things. So we thank you guys for following those. So GMAR has done a lot. Our next thing coming up, and you can see behind Terry Spiro our logo for GMAR tomorrow. We've decided that, now it's time to look to the future. We know where we've been. We know what we've done to try and mitigate some of these issues. And now we're moving forward. So we have been speaking with and surveying a lot of our volunteers at GMAR. We will be reaching out to all of you to get your thoughts on how Zoom is working, how the technology is working. Are we doing enough for you? Is there more we could do for you? So GMAR tomorrow is going to take us into the future, and we're really excited about that. So as we know, now's the time to buy. Interest rates are at 50-year plus lows. And although inventory is very short, get those sellers and be really sharp with your buyers. So one last thing, and I think it's important for all of us, especially in our real estate world locally. This year's a big year politically. This year's a big time for us to be prepared for the future. And so we have RPAC, the Realtors Political Action Committee. We have recently been interviewing candidates with regard to the primaries coming up, as well as the general election. And as an investor, it would be great to have all of you invested as well. RPAC really represents our business, and it's good business to invest. So if you want more information about that, you can certainly go to gmaronline.com. And August just shared that link with you. Travis Greer is our lead guy there. So he always has lots of great information. And that's it for today. So thank you all so much for all that you've done. Thank you for attending our session today.